and welcome to today's packed weekend video, which is called S&P 500 Bears Are Tired, but which assets do hold the best promise in current market environment. We will examine that through the ratios, individual charts, spanning real assets, Bitcoin, diving into the US dollar and yields so as to provide clues as to where we stand on the recession calls. Such is the weekly chart. We can see notable improvement in market breadth, but is it good? Is it good enough? You remember me featuring quite often the McLaren Summation Index, and this is still pointing to a select market phase which can't be disregarded. However, we have seen a clearly inside weekly bar with actually quite the buyers being on the controlling end, as they did not allow a return of the downtrend. This is also seen in the daily chart, where we can see quite an improvement in select percentages of stocks trading above various periods of moving averages, and this is moving in a quite synchronized way, though it's still beneath the key 50 level. However, this is one more clue saying that the bears are looking indeed quite tired. Couple that with the headline risk. Beginning of the week had been quite negative, as we had seen the tech relief news over the weekend being walked back already on Sunday, and now on a Thursday the White House meeting with Italian PM had been quite positive. Sure, I don't trust those headlines that China trade deal is coming. It would be among the last ones if it comes, because both countries need each other, and I don't see enough of a goodwill on either side yet to resolve those what is being perceived by each other as long-standing issues. The hourly chart, following the bullish Sunday gap that I had been preparing clients on the week ago, we had seen quite a steady drift lower. It had not been impossible to be making money in these market circumstances. However, those gains had not been as stellar as the week before. However, we had another fine week in the markets, even if these had gone largely nowhere, and even here you can see quite an exhaustion of the bears. Sectoral view. This is what must be paid attention to very clearly. Look at how the defensives had been performing. This is one-day basis, and clear disconnect with tech losing steam. Even on a 5-day perspective, we see that the defensive plays had been doing great. It's very fine that financials and industrials had been having an up week. However, is this really enough? We can see that if we fire up, for example, the 4-hour chart and compare where S&P 500, Nasdaq and Russell are standing. When it comes to MACD histogram, which is one of my favorite indicators, it's Russell 2000, which is quite looking to the bright side, to the bright entry to the next week, and it's clearly seen in the real estate, and it's clearly seen in consumer staples as well, which have been among the best performing sectors of the week. Of course, there had been well-publicized predictions of Fed monetary policy, the critique being late to rate cutting, and we will dive into the inflation metrics as well as we go forward, and it will be clear which side of the inflation debate I'm standing on. Volatility pools did not give us clear signs. The triangle is nicely unfolding, and thus far it confirms exhaustion of the sellers, meaning this ratio, my preferred one of the volatility, is having troubles rising. So for now we are kind of trending slowly sideways, which is quite conducive to the stock market as such going forward. Yields picture. Following the steep ascent on the tariff war backfiring, we are now starting then to see curling up again. What is most notable is the ascent on the long end of the curve. The short end is still kind of a hiding place, which is not that much subject to long-dated treasuries losing value. But the message that this as a spread 10 to 2 year is clearly painting of elevated spreads, and that's quite a sign going forward, and it's not exactly a risk on sign. US dollar can't find no respite, and it's visible across all the major currency pairs. And out of the three that I'm talking most often, you know that for weeks I've been talking the Swiss franc and how it is appreciating the Swiss franc versus the US dollar, and that's a very, very clear sign as to which phase the US dollar is standing in the tariff war, and how the rise of multipolarity is being accelerated as both camps aim to woo their respective spheres into their own orbit. Now, this part of the video is going to be about ratios, out of which will follow whether we are more leaning towards the risk off or risk on phase in the markets, and which assets are the winning ones in such an environment. When gold is rising this wildly against silver, it's a clear risk-off sign, and trading signals clients had benefited mightily on those bullish gold calls of late, coupled with necessity to protect open gains, because not even gold was subject for a brief period of the forced selling. When it comes to copper to gold ratio, we are seeing very tentative signs of stabilization, and it's nowhere near another sign of risk off, and troubled prospects, worries about global recession knocking on the door ever so slowly. Oil to gold, very clear case of global recession worries, another risk of blank in the puzzle. Stock market ratios, financials to utilities. It's hard to see stocks convincingly returning to an upswing when financials are relatively underperforming this way. And it also shows very nicely, this ratio, how the post-inauguration top right before tariffs moved to the spotlight had been accompanied with stock market declines, which is of course as well very nicely mirrored in the series of lower highs being made in McLaren Summation Index and other market breadth indicators, which are still within their downtrends. Advanced decline line had not been painting a positive picture either, and I have been talking ad nauseum the bearish turns in the bond market when it comes to risk taking. So this is another stock market ratio, this time one sectoral one, that is mirroring the turn towards the caution, meaning that what is a bounce must be treated as an oversold bounce, and very nimble traders are going to be the ones that are going to be winning in this environment. And for now, we are having still the quite bearish leaning medium-term technicals, with coupled with slightly positively leaning headline risk going into next week. But that does not mean that stocks would not revisit, not aim to revisit their recent lows within, say, 2 to 4 weeks. Much depends upon the tariff, the headlines. Practically all depends upon how the credit markets and credit default swaps are evaluating that situation. So much for this ratio, and moving on to the next one, which is clearly painting the worries seen within the consumer land. Discretionaries to staples. Clear downtrend ever since the inauguration, and you can as well view this almost get another perspective by viewing it through the retail XRT ETF. So that's another way how to view the retrenched consumer that is somehow still disconnected when it comes to actual retail sales, which are not nearly as badly cratering as this ratio. So far, the soft data, meaning sentiment, and expectations, inflation expectations, have not yet translated into actual retrenchment within actual spending. Now we will revisit select commodities, and I had been already in autumn last year talking that sugar would need to trade clearly and convincingly above, say, 23 cents for inflation fears to be taken seriously. And we can see that this is kind of mirroring the very cautious, tame, and disinflationary trueflation data. So this is illustrating the disconnect between the realities on the ground versus consumer expectations. Soft commodities, agri-foods. These are as well nowhere near their ascent and have been dialed back considerably. It's not just oil cratering, it's not just base metals that are reflecting the tariff war and global growth uncertainties. It's as well agri-foods. So worth noting that this is still, for all the geopolitical uncertainties and attempts to redraw the financial universe landscape, this is as well painting a rather risk-off signal. So what are the bright spots? Bitcoin is one of them, and I do think that this is nicely building a base to go higher. 95,000 is not out of the question over the quite a few weeks ahead. 10 expectations, but still this is looking to be slowly building up so as to peak higher from here rather than lower. Note how the moving averages are starting to turn, and don't worry about all those death crosses, and these are not the most reliable and timing perfect tools to base one's trading, let alone investments, on. Another view of the precious metals market, and we can see here quite well how silver had been lagging badly, is having trouble rebounding, and the gold downswings have been and still are being quite readily bought. Miners are as well nicely tracking gold. So here you see it as the tariff war had heated up, with China not at all relenting and ready to escalate as much as the States are. This is painting a clear risk of sign, and it would be only if I see silver starting to accelerate versus gold that some notion of return of inflation can be entertained and discussed. We are nowhere near that. Oil. I've been favoring talking with clients in Thursday's pre-market analysis that oil is building a bear flag that will turn into a rising wedge, and this is exactly what's unfolding. And we know how those rising wedges tend to end. They tend to break to the downside. So this one is still in the making, and I'm still waiting for at the moment where the topping pattern, where the momentum, where the juice starts running out, so as to ring the bell and go short oil again, because this one is not going to escape the global recession fears, not in the least, and it had been clearly visible in the hammering ever since the opening part of this month. My joint page will help you decide what's right for you based on what and how you trade. Combine the daily analytics with intraday channels for the greatest punch and full scope of everything what I do. You know pretty well my trading story, obligatory disclaimer, and happy Easter wishes, and enjoy the greatest time and spiritually recharge.